Let me take you back to 1983. Now, amazingly, that's 40 years ago. Well, 1983 was the year when Michael Jackson released Thriller, and I also remember waiting in a huge line to watch Return of the Jedi at the cinema. Nintendo released the first games console, Motorola released the first mass-appeal mobile phones, and a standard internet protocol was adopted for the first time. Now, 1983 was a very important year for the global oil markets. The Iran-Iraq war was raging, but there was still too much oil on the market, and prices were hovering just below $30 per barrel. At that time, the oil price had been relatively stable for some years, but it was starting to become more volatile as OPEC's control of the world oil markets diminished. It was amid this backdrop that the NYMEX exchange in New York, which is now part of cmegroup, launched its light sweet crude oil futures contract. That futures contract has become best known as WTI. Since that launch 40 years ago, WTI has established itself as the most significant commodity contract on the planet. Nowadays, the price of WTI crude oil sets the agenda for the entire commodity suite, and changes in the price of WTI can literally move economies. But it didn't take off immediately, and just 3,000 lots of WTI changed hands in the first months of trading. It took another year for WTI to breach more than 100,000 contracts in a single month, but after that the growth was explosive. By the end of the 1980s, WTI was trading more than 2 million contracts per month. And in recent years, we've seen plenty of trading sessions when WTI trades more than 1 million contracts per day, and even more sometimes. Now, this dramatic change in trading activity over the past 4 decades reflects the awareness that oil prices are unlikely to ever go back to being stable and predictable. The last 40 years have seen multiple geopolitical events that have affected the supply of oil. This great uncertainty surrounding oil prices, which is crucial for so many companies, has made it more and more important for firms to try to manage their exposure to oil prices by hedging with futures. And this trend towards greater awareness of risk management has been a key theme in the last 4 decades. WTI crude oil futures have helped firms take out price insurance to avoid downside risk if they're a producer or upside risk if they're a consumer. A 40th birthday is often an opportunity for some self-evaluation. Certainly much has changed since WTI was launched at the height of disco fever in the Cold War. When WTI first launched 40 years ago, the oil market in the US looked very different. US oil was not exported, and it was widely believed that US production was on a one-way downward spiral. The shale oil revolution has changed all of that by unlocking vast new supplies of crude oil. In recent years, US production has surged once more from 8.7 million barrels a day in 1983 to its current giant level of 12.4 million barrels per day. At the same time, US exports have soared to record levels from virtually zero when WTI launched to a current rate of over 4 million barrels a day. That means that in recent years, WTI's importance has been extended way beyond its US heartland. A major build-out of pipeline and port infrastructure has linked WTI's delivery point of Cushing, Oklahoma to the world via the export terminals of the US Gulf. The growing role of the US as a major exporter has made WTI ever more relevant to the global markets, and WTI-linked rates now play a key role in supplying Europe and Asia. So as it hits middle age, WTI shows no real signs of slowing down. Despite growing environmental awareness, oil demand is expected to continue to grow over the coming years as countries industrialize, ensuring that the need for a reliable price benchmark and for risk management has never been greater.